Chapter 3 begins a two-chapter review of fundamental accounting principles. As we saw in Chapter 1, accounting and finance are closely related. Much of the data used in finance comes from accounting statements, so we need to have a basic understanding of what they contain, what the data means, and how it can be used. The 4 financial statements required in a firm's annual report include the balance sheet, a snapshot of the firm's financial position at a specific point in time, the income statement, a summary of a firm's revenue and expenses over a period, such as a quarter or a year, the statement of cash flows. This is an important report for finance, as it's the one that reconciles accounting statements to cash flow, which is the focus in finance, and the statement of stockholders' equity, a short but important report, as it tracks how much of net income is paid out in dividends and how much is added to retained earnings. To demonstrate the use of financial statements, we're going to follow a hypothetical company, DeLeon Incorporated. DeLeon is a small snack food producer in North Florida whose specialty is pecan and nut products. In 2018, they decided to embark on a major expansion in an effort to capitalize on their high-quality reputation and to compete with Frito-Lay. The company doubled its plant capacity, opened new sales offices outside its home territory, and launched an expensive advertising campaign. DeLeon's results were not satisfactory, to put it mildly. Its board of directors was most upset when they learned how the expansion was going. Unhappy suppliers were being paid late, the bank was complaining about the deteriorating situation and threatening to cut off credit. As a result, changes have to be made, and quickly. Here's the asset side of DeLeon's balance sheet for 2018 and 19. Clearly, their cash position has deteriorated significantly. Accounts receivable and inventories have increased by almost 100%. In addition, net fixed assets almost tripled. Looking at the liabilities and equity side, all liabilities increased. Accounts payable ballooned by 260%. Notes payable increased by 218%. Long-term debt more than doubled. Retained earnings declined by 84%. These are seriously bad changes in the firm's position. DeLeon sales did increase significantly, 78%, after the expansion, but cost of goods sold increased by 93%. Net income went from $110,000 profit to $160,000 loss, a swing of a minus 246%. No wonder the board of directors are upset. These results for 2018 versus 2019 make it clear why shareholders are not happy either. Earnings per share declined by 218%. Dividends per share were cut more than in half, a bad signal to the market. Most disturbing, the stock price dropped from $8.50 per share to $2.25, a 73.5% decrease. DeLeon's statement of stockholders' equity is a simple statement since they did not issue any new stock. Beginning of the year retained earnings plus net income, which was negative, minus dividends paid equals end-of-year retained earnings. Note that even though DeLeon reported a negative net income, they paid dividends anyway. Dividends were paid out of retained earnings, which belonged to the shareholders, but were retained to reinvest in the firm. Let's look at the last of the 4 financial statements, statement of cash flows. This is an important statement. This is the only place where accounting numbers are reconciled to cash. Accounting's matching principle requires estimates and accruals. Financial analysis is concerned with cash flow. Balance sheets and income statements can and are manipulated. Cash cannot be manipulated. Either you have it or you don't. A firm needs to translate sales and earnings into cash. The statement of cash flows has 3 sections: cash from operating activities, cash from or used for investing activities, and cash from or used for financing activities. The objective is to reconcile beginning of the year cash with end of year cash. Here's the cash flow from operating activities for DeLeon. The result is negative, driven by the negative net income. Now, this is not an accounting course, so we're not concerned with creating a statement of cash flows, only with understanding and interpreting one. Note that in general, you want a firm to make money from operations, from what they say their business is. Here are the other 2 sections of DeLeon's statement of cash flows. They spent over $700,000 on new plant and equipment. They financed this by issuing notes payable and long-term debt, yet they paid dividends anyway. When we cover common stock, we'll see that it's a very bad signal to eliminate dividends. Reducing dividends is bad, but not as bad as dropping them altogether. Summing the net figures from each section and beginning cash should result in end-of-year cash. Our overall conclusions from De Leon's statement of cash flows. Net cash from operations was driven by negative net income. The firm borrowed heavily to finance their growth, and even after borrowing, they still dipped into cash. Before we go any further, we need to differentiate between two types of net working capital. The traditional definition of net working capital is current assets minus current liabilities. A more refined definition is net operating working capital, NOWC. Net operating working capital is only concerned with operating assets and liabilities. Short-term investments, De Leon doesn't have any, are not an operating asset. They're an investing asset. Notes payable are not an operating liability. They're a financing liability. So for De Leon, net operating working capital is equal to current assets minus the quantity current liabilities minus notes payable. After-tax operating income takes taxes into account, but not interest expense. De Leon's after-tax operating income swung from a positive $142,821 in 2018 to a negative $28,600 in 2019. Remember our defined definition of net operating working capital. De Leon's net operating working capital increased by $120,000 from 2018 to 19, driven by increases basically in all the components. Recapping, sales increased by 78.5%. After-tax operating income declined by 120%. Net operating working capital increased by only 15.4%, but net income declined by 246%. The formula for free cash flow is shown at the top of the slide. Note that capital expenditures equals the change in net fixed assets from the balance sheet plus depreciation from the income statement. And yes, depreciation is added in the first component, subtracted in the second. De Leon's free cash flow for 2019 is a negative $744,000. Negative free cash flow is generally not a good sign, but it can occur during an expansion, which is the case with De Leon. However, coupled with De Leon's poor performance in other areas, it's not a good sign. Our final topic in this lesson covers taxes, individual and corporate. Both personal and corporate taxes have been based on a progressive structure, higher income, higher rate. Individual taxes are still progressive, but the corporate tax rate is now a flat 21%. New tax legislation modified the tax rates for both individuals and corporations. The previous top rate for corporations of 35% was lowered to 21%. Business interest deductions were modified as well, with a limit of 30% of EBITDA through 2021 and then 30% of EBIT thereafter. While the personal rates were lowered, which we'll see on the next slide, the reduction in the corporate rate was much more dramatic. For individuals, rates begin at 10% and rise to 37% for single individuals with income over $500,000, married couples filing jointly with income over $600,000. They, of course, may be subject to state tax. The standard deduction has increased for individuals to $12,000 and for married couples filing jointly to $24,000, causing many to choose the standard deduction over itemizing. The personal exemption was eliminated. For corporations, interest paid is tax deductible, as we've seen on the income statement. For individuals, only home loan interest is deductible. Interest earned, except on municipal bonds, is fully taxable to individuals. Dividends paid are not tax deductible for the paying firm. They are paid out of after-tax income. Dividends received are generally taxed. In the 10 to 15% bracket, no tax. Middle brackets, 15. High tax brackets, 20. Dividends are double taxed. First, they're taxed at the corporate level, and second, they're taxed at the individual level. If a firm owns a non-controlling interest stock in another firm, dividends on that stock may be tax exempt. Corporations are permitted to carry losses back or forward to offset profits. Capital gains are the profits from the sale of assets, physical or financial assets. For individuals, gains on assets held less than a year, ordinary income. Gains on assets held over a year, long-term capital gains. Most pay 15%. The highest tax brackets pay 20%. This ends our review of financial statements. In the next chapter, we'll continue our accounting review and follow De Leon for another year.